Welcome to Lighthouse Outlook, the podcast where we talk less about the markets and more about what matters to the people navigating them. From family offices to founders, we go beyond the numbers to unpack risk, legacy, and the human side of capital. Hosted by the team at McNichol & Associates Asset Management.
Okay, good morning. Welcome to the May 14th edition of the MAAM research meeting. Just a couple of slides on some 13th floor developments, and then a very brief charts of the week pack. Andrew is on vacation this week, so it was pretty lean. Still informative, but just not a lot of slides. As always, just drawing your attention to the disclaimer here. And let's get into the action. So this is a 13th floor property called Lincoln Boca, and it's a mixed use, transit-oriented, essentially rail station. So it's hard to see from the picture, but it's basically a multi-res development with a transit link. And so this is a $100 million construction loan financing and development project with another group that the company is partnered with, and so with 13th floor, they have kind of shifted a little bit more. Like they've essentially bifurcated their LPs into development work, which is stuff like this, and their residential 13th floor homes division. So if you drive around South Florida, you'll actually see subdivisions, and there's one coming up where they have sort of the active residential part of the business, which cranks out cash flow, and then a lot of these kind of higher torque development plays. The next one is Casa Cipriani, which sounds really cool. This is another refinancing and development project in Miami Beach. So you can probably drive to this one. Looks like that after these are pictures of the development, but it's going to be 20 private residences, fairly nice ones actually, and a 36 unit luxury hotel with a members club. So all the bells and whistles there. And then finishing off with the Woodland. So I think this is the one we actually took a tour by Dave in past years, and these are just what I would call single family product in Tamarack. And this used to be a golf course. Okay, so that's something that the local authorities actually really like is you have a developer come in and pick up a golf course that's behind on taxes and just behind in general, and start putting homes there. It's a pretty slam dunk, easy, no brainer. I mean, you can't be reckless about it, but it's certainly something that is a good deal for investors, but also residents and the local municipalities. And with the golf course, usually the lands are in pretty good shape, so there's not too much processing that you have to do. You just kind of start cranking out homes. And just as an FYI, a lot of these homes in Florida don't have basements just due to the sort of sogginess of the ground. It's the case that they're more just main floor dwellings. They're also hurricane proof, so the windows on these things are literally double the thickness of the ones on our places up here, and they're really heavy. Like if you actually go to these properties and like try to move a door, it certainly has some heft to it. Really quick charts of the week pack, just like I talked about. Andrew, I think, is going on what he calls a rare vacation. So you can see the S&P 500 here in this slide up against the second standard deviation line. And then he compares past sort of peakish periods, going back to the 50s, which was really good, wide angle view of the last 76 years, which is a long time. And then you get these periods where the market is peaky and then it cools off and continues higher. Right now, the S&P 500 is coming up on 150% above its long-term 200-month moving average, and it's only been this extended a handful of times. Um, the occasions in the past where it's done this have been like if you go to the 50s, it actually was up there for a fairly long period of time, like several, like almost a year. Whereas in 87, it sort of, poked through that level and then came crashing down. And then the dot-com bubble was an even more extreme case where, that bubble was being blown up since 1987. And then, of course, by 2000, you had like all you had to do was put .com after your company's name and the market cap would double, which is funny. Can you imagine just changing, the name of your company and the valuation goes up? Sorry, I just find that really, really funny. But that's sort of the thing there in terms of the really it's the risk perspective. Like again, getting into the markets now isn't a bad idea if you've got sort of downside protection, but just flagrantly piling into certain areas of the market could be a little bit dicey. And then a few more quick ones. So the major thing that sort of stands out relative to where the market is at is this U.S. new high, new low tracker, which is low. And so what that means is despite the market on the front end going up and people, talking about the stock market and all this kind of great stuff, there's a lot of companies that are actually making new lows, which is not it's a little bit depressing if you're an equity investor, I guess is the best way to say it. And then I think the last one here is might not be the last one, but it looks like it is the NYSE's percentage of stocks above their 50-day moving average. It's it's kind of trending down. I know it looks like it's popped up since April because it has, but it didn't really get through that former upper red line there. And that's pretty much all I got, guys. So I'm sure some of you are like, thank goodness he's not going on for half an hour. Ken, over to you.
Thanks, Joe. I appreciate that. And no one thinks that. Okay, perfect. Just quickly go over the disclaimer again, the Canadian one for Canadian viewers, and then here's the one for folks down south of the border. Just contact us through email or websites to ask any questions around securities. Looking here, the S&P 2-box increase, which moves the melt up higher, supports 23 boxes lower now. Year to date, the S&P 500's up about 9%, really being led by the Mag 7 and semiconductors. Most other components this week, when I was looking at a chart of all the S&P 500 companies, down, other than really one-offs, and then the two groups of names that I just mentioned. Overbought, oversold 98%. That's an increase week over week. It's been overbought 6 weeks in a row and heavily overbought 5 weeks in a row. Really seems like there's been a return to risk from investors, especially into U.S. equities, despite valuations of all these indices being elevated. NASDAQ, kind of similar story, 3-box increase. This is the third straight week we've had an all-time high on this chart. Up 15% year to date after being down pretty substantial. I think 5 to 6%, maybe 7% at the low. So quite a 6-week turnover. Really a high octane move upwards. Tech continuing to lead this rebound. Obviously, AI hope, peace talks, potential China-U.S. resolution on trade this week. You can see here no near-term support after this melt up. The price objective continues to move higher. It has broke 5 months of negative momentum, overbought, oversold for the second straight week at the highest it's been at since January 2020, 129%. And then the valuation very expensive. So for what I said about the S&P 500, maybe double it for the NASDAQ 100. Looking at the Dow here, it actually had a $3 decrease, and this is where we see the dispersion between growth and value. We've talked about it in the recent, I'd say 3 to 4 weeks. It's continued this week. The growth value performance of the last 6 weeks really is reflective of, in my opinion, exiting out of a recession where you have these high octane growth names surging, perhaps after they tanked, and value kind of lagging behind. But that's obviously not the case. Overbought, oversold 44%, moderate demand over the last 5 weeks, but not in the correction zone, what I would call, like the other two names. Like the other two indices. And then really for the Dow, only strong weeks, I'd say, for its components, the NVDA, Cisco, and United Health. So a lot less breadth than we had a few weeks ago for both the growth indices as well as the value names, or the Dow. Looking here at the TSX 60, no box change this week. Only up about 5.4%. A couple months ago, the TSX was greatly outperforming its U.S. counterparts. Some commodity volatilities kind of remove that. You can see here, it's got a strong setup in terms of support lines. It has one resistance line above it. It trades a lot more cheap than the U.S. indices. Obviously, no surprise there. But there's been some weakness among some commodity or some non-commodity names on the TSX recently, some financials, tech, etc. So perhaps a bit reflective of a breakdown in the Canadian consumer, but we'll have to continue to watch that as the next quarter starts reporting in just a few months. Overbought, oversold 24%, 7th straight week overbought. Most of the TSX weeks in this recent trend have been overbought in the 20 to 40% range. So nowhere near that heavy pressure where it's going to potentially correct in terms of supply and demand in the coming weeks. But also perhaps a bit of a rotation from investors back to the US away from Canada after a strong 2025 for Canadian markets. Looking next at the VIX, about a 2% increase week over week. It seems like it bottomed last week and moved higher off this low. We'll have to see if that continues. I obviously marked that trend reversal after we've had these two strong trends to start this year. But nonetheless, the VIX still sitting at 18% despite all of the uncertainty and some volatility still remaining in the market. Bullish percentage chart. These two charts moving slowly down on recent weeks despite markets sitting at all-time highs. Kind of coincides with what Joe said. A lot less breadth in the market right now than we saw just a couple of weeks ago. These are percent positive trends charts. These are a lot more slow moving, like I mentioned, and there hasn't been a grave change in the overall trend of markets, and thus the components bullish trading in a positive trend or a negative trend is more of a long-term moving chart versus the bullish bearish chart, which is a little more medium term. So not a surprise that the latter hasn't moved in recent weeks. TSX here, no changes, so I'll just quickly flip over that. And then looking at the asset class rankings, not a crazy amount of movement. Commodities gained a significant amount of buy signals this week, some strength in industrial metals and as well energy. Other than that, the only other movements, basic materials jumped, kind of correlates with that move with industrial metals. Utilities dropped back a couple buy signals, but not a huge change. And then tech continues as it sent after really bottoming a couple months ago, is now back into the number 2 position, and more than likely could reach that number 1 position if the volatility in the energy trade continues. Looking here, this is kind of coincides with that recent point that I just made on the tech sector. This is XLK State Street's tech ETF. You can see it a recent pullback, but since mid to late March, this fund is up about $48, which would be more than 40% return in 6 weeks. You can see over here on the right side a histogram of the overbought, oversold weekly indicators over the last, I think, since this XLK fund launched. But you can see as of, I think this is Monday, the weekly overbought, oversold was in the highest percentile. And then the week before last week, sitting at about 136%, sitting in the one below that. So we're in this extreme territory where we could see a bit of I'm not going to say a correction in the market, but a correction in a lot of these numbers. And we could see some selling pressure, especially in some of these tech names that are extremely overbought right now. So just wanted to show that chart. Looking here, this is the S&P 500 PE spread between the last 12 months and the next 12 months. You can see we're at the highest point really since post-COVID, and that was kind of an enigma because of the compressed earnings due to the shutdown of all of the governments across the world and all of the economies across the world. And we're sitting at this point, which is at the highest point in terms of history on this chart. But basically, we just passed the highest level it's been at since the pre-dot-com era. And historically, what are the returns for the S&P 500 when the last 12-month PE ratio subtracted by the next 12-month PE ratio hits 7? You can see the prior 2-year return, obviously very strong markets. Same with the prior 1-year return, very strong market. Forward 6 months, pretty strong market. But then you get into the forward 2-year returns and the max 2-year drawdowns. The only other times that these have happened, 99 and 2021, so very selective statistic, but nonetheless, perhaps something to watch with where we're sitting at in terms of the PE spread on that chart. Again, talking about breadth here, a lot of these slides are kind of on the same topic, breadth. This is the Mega 5, which Dorsey Wright tracks. Right now, that currently consists of Apple, Microsoft, Google, Amazon, and NVDA. 5 mega caps, you'd call them right now. Still, obviously, dominating the land market. It's up about 18% over the last 30 days. The 18% move is about a 98.4 percentile move for any individual month for this Mega 5, which they've tracked going back to the 90s. And the S&P 500 is similarly strong with a 97 percentile relative performance. So you can see we're in these extreme levels over the past, I'd say more like 6 weeks. I think Dorsey Wright's just tracking the month of April for the most part on these studies, but nonetheless, sitting at these extreme levels. Looking here, this is the EMXC versus the MCHI relative strength chart. EMXC is the iShares Emerging Markets ex-China ETF, a little less liquidity than the typical EEM ETF. And then the MCHI is the iShares China ETF. So on this right chart, moving upward, the emerging markets ex-China group has the relative strength. Moving downward, China, obviously. And we've seen this massive surge in recent months of strength rotating towards the emerging markets, not China. And that's, I think, more part of a broader trend where we're seeing investors diversify, looking for alternative exposure. Last year, specifically, alternative exposure to the US. Investors had been rotating emerging market exposure away from China due to the more geopolitical risk for a few years. I know we obviously have, the only exposure that we have to China is through the EEM ETF, but have looked for alternative exposure over the last 5 to 6 years in the emerging markets group. But you can just see at this point, even this emerging markets ex China ETF, how overbought it's at right now. Just the velocity of this move since the lows of late March to now. And even this relative strength chart, you don't see these massive volatile moves on these charts in just such a short period. Beyond that, moving over to Go Easy, I was quickly watching BNN actually the other day, and I mean the stock's gone, we all know, 225 to around 29.50 in less than a year. And apparently BNN said that they were thwarting takeover bids. I think that perhaps a takeover bid is what this company needs to reshuffle the board, reshuffle management. But right now they're being pretty resistant. We don't have any exposure, and obviously they're just following along the story, just like the rest of Canada. But pretty interesting, I think there. Other chart here, just wanted to highlight. This is a chart from UBS. Just broadly tracks the last net import/exports over a 5-year period. In China for silver. You can see in February and March of this year, imports came in at the highest level in 20 years. So China, once always a net seller of silver, seems like right now they're net buyers just like they are of gold. Speaking of gold, here's the junior gold miners ETF, which looking at this candlestick chart, this is only a I think this is just a yearly chart, but very similar setup to last year. Just broke out of this resistance line that it's been trading at since the highs that we got back in February. Perhaps a move higher right now, especially with gold prices kind of remaining stable after a bit of a volatile, we'll call it January, February, March. Looking here, this is the S&P 500 healthcare versus the S&P 500. This is the price to sales ratio on the top. S&P 500 trades at about a 3.5%, or excuse me, 3.5x price to sales ratio. S&P 500 trades at about a 1.47. That's about a 58% discount. Now, why do I bring this up? The return on equity for both of those groups is the same. So there's a bit of a discrepancy, and I've seen more and more groups talk about the healthcare industry and just the opportunity set that is presenting itself right now compared to a lot of the other industries that aren't reflecting those margins, 2 returns on equity or investor capital, and 3 are continuing to see some growth. Looking here, this is a chart that tracks momentum versus minimum volatility. This is the 5-year this is just pure relative strength, like I mentioned, but on a trend chart, you can see where we're sitting at right now for momentum versus minimum volatility. And MSCI and Alpine Macro, who created this chart, say that we've basically overshot the trend by a 5 standard deviation, and that's larger than when we did in February 2021, June 2008, and March 2000. So really the blow-offs on these charts where investors really chasing returns into pure momentum investing. That's why we always say adapted momentum when we're looking at momentum strategies that we look for. But you can also see where you underperform in some of these bull markets, investing purely in a minimum vol investment style. And I think that's it for me. So I'll pass it over to David.
Thanks, Ken.
No problem.
Yeah, I'm probably going to be fairly brief as well today. So get at it here with the video that just came in now. So let me put it on here.
Good morning and welcome to the morning brief for May 14th. My name is Joe Tizzolo. jumping right into action yesterday. Pretty positive across the board. EEM emerging markets were up over 2% yesterday, leading the way for the global equity market. We did see gold and the dollar up yesterday, which has been interesting. Crude oil was down about 1%. And then we also saw bonds down yesterday as well, with pretty hot PPI print yesterday morning. Another interesting thing as well is the S&P equal weight was down about 40 basis points yesterday, while the S&P cap weight, or just a normal S&P, was up nearly 60 basis points. The move over the last couple of weeks has really gotten top heavy, where at the beginning of the year, we're kind of talking about how equal weight and breadth were doing really, really well in the large cap space. Since the bottom in March, it's really been a cap weight, mega cap name driven rally. Also, we did see the Dow down yesterday as well. And in part, its higher weighting in financials has really been a deterrent over the last 6 months or so. Looking at the State Street Financial Sector Spider ETF here, XLF, we see a fund score below 3. This is the 50-cent chart, but unable to be at all-time highs with the rest of the market, which is never a good sign. And a lot of resistance here in the mid 50s. So something to keep an eye out for, especially if you do have financials exposure right now. Probably a place that you want to start to trim or underweight if you haven't already. Speaking of the broad market, marked another X yesterday, so now at 74.50 for the S&P. Weekly overbought oversold is near 100%. While sometimes historically we see overbought readings, that may mean the market kind of cools off, even if it's just kind of trading sideways for a week or two. But typically what we see is that over longer time frames, it's the strong markets that are becoming overbought in the first place. So not necessarily a negative sign by itself that the market is in heavily overbought territory right now, just that it may not move like it has over the last month and a half. One thing I do think is showing some warning signs, we wrote about this yesterday, is looking at the implied volatility for single stocks within the S&P 500 and the index volatility itself. So you're always going to see single stock volatility almost always or average single stock implied volatility almost always be higher than index volatility, because correlations within the index kind of lower the overall volatility. Maybe Google's up but Microsoft is down, for example. That leads to lower index volatility, but on a single stock basis is still going to be a bit higher on average. One thing we kind of keep track of periodically here is just the spread between the average stock implied volatility within the S&P 500 and then the index volatility, or the VIX. This has reached its highest level ever at the end of April, and our data set going back to 2010, essentially saying that single stock volatility is really elevated relative to where the index volatility is. And we've seen this happen a few times, and usually it does lead to either index volatility catching up or kind of a collapse in single stock volatility, which would mean that maybe a little sideways action moving forward. But we will see how that shakes out. If you want to read more on that piece, it's on the Research Hub. Uncalm Beneath the Surface is the title. Also, with that hot PPI print yesterday, we did see Treasury yields continue to push a little bit higher here. TNX now on 3 consecutive buy signals, kind of quietly nearing the top of this range it's been in over the last couple of years. 4.6 to 4.75 or 4.8 has really been where we've seen yields kind of unable to stay above those levels here, act as a big area of resistance. We'll see if that's the case this time moving forward. And then lastly, on the single stock side, Cisco Systems announced earnings after the close yesterday. This is one of those stories of, something that's overbought can also get more overbought. It's a perfect 5 for 5-er. It was 150% overbought at the close yesterday. It's up about 17.5% in after hours action. So you'll probably see that overbought reading become even more elevated here after today. But just something I wanted to point out, especially during earnings season, things can get a little bit wild, even if the stock is already overbought. And typically, not always, but we do see higher attribute names typically do a bit better during earnings season than low attribute names. So that is also something to keep in mind when you're going through your portfolios. With that said, we'll go ahead and wrap up, and thanks for joining.
Okay. I'm not sure if I learned much from that guy this morning, but it is what it is. So let's go and carry on to the rest of mine. Okay, Michael Coolbaugh is back in action this week, so I'll go on to him next. Okay. Less goods for more. So here we go with inflation. Yeah. Inflation adjusted retail sales in red, nominal retail sales in blue. Not really sure what that means when the blue goes above. He feels it peaked back after COVID. Okay. The gamma squeeze is alive and well. Retail call buying nears 2021 extremes. So this is some derivatives options. So meme era stocks are going to be coming back again. We've already seen evidence of those. Okay, here comes another person. And so more meme stocks. History of bubbles. Okay, this is going back a long time. We talk about this every single week. And here's some more data points. You've got railroads back in the 1800s peaking out. Then you had the Nifty 50 back in the 65, late 60s era. Then you had Japan in the 89 peak. And then, of course, you had the techtelecom.com peak, 41% in 2000. And now you've got the AI Big 10 percent S&P 500 peak at 40%. So, yeah, how much higher can this go? That's actually a good one. We might keep this one, Ken, and grab for some future usage. So look for Mike Coolbaugh's deck for that one. AI hype reaches far and wide. So, yeah, there's good old VRT at the top. We like that one. That's done well for us at 138 billion. Top 20 non-tech S&P names trading like semis. And so on down the road. Caterpillar. That's how they correlate with SMH, semiconductor stock. The memory craze in South Korea. Okay, so this is the South Korean market, which we own to a certain degree. The reason I find this relevant is because this silly headline sent many semis down over 10%, just showing how vulnerable a call option frenzy-driven rally can be. At one point yesterday, South Korea was down greater than 9.5% on reports that the government may introduce a tax on profits to distribute the wealth benefit from AI, Samsung, and SK Hynix. This windfall tax was dismissed, but I believe that had to do with the violent unwind in semi-stocks here in the US. People may think this over, but there are new stories that Samsung may face a worker strike as they demand more participation in the profits from the AI memory boom. Okay, worker strikes, more signs of inflation around the world. Warning for financials, as that gentleman just pointed out, financials have not participated in this latest leg of the rally. Some big names, Wells Fargo, Bank of America, have shown a lot of weakness, underperformance in one thing, but bank stocks falling on an absolute basis is typically a warning sign. Okay. Consumer stress, retail as a group has seen significant weakness the past couple of weeks. Our list of new 20-day lows is littered with apparel, cosmetics, discount retailers, and travel. Yeah. Five Below Inc. With falling real incomes and persistent strain from the Strait of Hormuz, we're starting to see signs of stress from discount retailers. Yeah, they're just not going to be getting their goods. Walmart. Besides, AI investors are hiding out in staple type names like Walmart. Only problem is you're paying peak multiples last seen at the peak of the .com bubble. So there we go. Another example of a peak valuation going back to the year 2000 in a quality name like Walmart. Gap. Evidence for consumer strain starting to show up in the extreme weakness across the apparel industry yet again. So there's the Gap. Agriculture fund, with negotiations producing little to no progress, the stress on energy markets and broader commodities continue to build. Agricultural commodities hitting new decade high, more trouble for consumers. And that's it. So lots of content there today. So well done, Mike, Mr. Kuba. Let me just see if the morning coffee ever arrived. Nope, not yet. So these are the day before's numbers. So shouldn't it be changed too much. Year to date, once again, the only red spots, France, Germany, and Australia break even basically, and then India. So Japan has been the winner on the year to date race. And yeah, Canada, it looks like the venture exchange has come back here just of late with the strong week and getting stronger in Canada. The commodities, I'll probably cover these better with the point and figures, but oil continues to move up, and nat gas is actually coming off a bit, sort of flat for the year. Mixed results for gold, and silver is very strong here. Look at silver up almost 20% versus gold at 6.5%. Okay. And then finally with our dollar, no change there, still 73 cents relative to the US. Bitcoin is up 80,000 and sort of flat on the weekly. The monthly has been strong for it, but year to date it's still down. And then we just saw on the 10-year, this is the price of the 10-year, has been slightly down, but looked a lot worse on his last slide on the TNT. So I'll find that when I get to my point and figure slides here. Okay, point and figure, Canadian dollar still the same. Short-term target of down to 69 from 73 where we are now, and long-term down to 62. So I think we're just in a holding pattern there for our dollar relative to the US. No change in the US ICE at 98. It measures down to 95. So no change there. Okay, got to do it this way. Yeah, we're just going to talk about those two currencies. There's a world of other ones to look at, of course, but just focus on those today. Okay, crude up over $100 and measures down to 70. It's up 75% year to date. Nat gas looks like it has some upside according to this mathematics, but down 22% year to date. And the energy complex also measures up 28%. Copper looks like it might be peaking out here, as same as uranium. Gold measures up in both the futures, the continuous futures, and the spot price. As do the gold bug index and the VanEck majors, but the VanEck juniors actually look like they're peaking out here. So that's different from that chart we saw earlier, I think Ken's chart. Silver up, and silver miners up, and even the silver juniors up a bit. And yeah, platinum also up. Yeah, that forecast number for Bitcoin still hasn't changed at 22,000, and the rest of the digital complex looks to be upwards. Yeah. Finishing up here on interest rates. So the 2 years actually moved up to almost 4, so that's moved up a bit, but it still looks like it wants to come down here to 275. So that's up sort of a 0.5%. The 5-year measures up, the 10-year up, and the 30-year up as well. So this is what he's talking about with the 10-year, up 7% year to date. Not quite as much as the 5-year. But that just means not the price. This means the yield on these. So up is bad. That means that people holding these, especially if they hold them in a fund, have been losing money in the what should be safe space that way. Yeah, I see there's a podcast that came out this morning for Dorsey Wright, so I'll be listening to that later. And I think that's it for me. So who wants to go next? Sean Cumby is sick today. Chris Curry, do you have any updates?
I think in the fixed income market, we've gone over the inflation story. Interesting dynamic with the new Fed chair, Kevin Warsh, being appointed. And, he's like the guy, Stephen Marin, that he's replacing. I think the next meeting will be Stephen Marin's last meeting. He's sort of a Trump appointee and cutting, but the market's saying that these guys are pretty much going to looking at potential hikes. So apologies, am I going to give you the interest rate forecast for hikes, but my screen's just not working. So, but I would say that the 2-year is certainly the rise in the 2-year, with the midpoint of the Fed funds at 3 5/8. The 2-year at 4% is certainly implying that there's going to be at least a 25 basis point hike in the market. So, I guess inflation's here. The question is, 6 months down the road, do we see more inflation, or do we see a lot of demand destruction and very weak labor market and potential talks of recession? So the near term, I think, is kind of well known and built into the numbers, but the 6 month, 8 month, that's where we really have to focus our attention on trying to come up with a scenario. And that's it for me.
Okay, thanks, Chris. Paul, do you have anything to go over?
Hey guys, okay. Here's an idea that was just pitched to us by this guy David McFadgen over at Cormark, now ATB. We listen to him quite a bit. We find him very insightful, right? He got us into MDA a couple of years ago. Totally fabulous investment. And he got us into Telsat in a big way. And he's very bullish on Telsat, by the way. He's got a target price of verbally, he's written his target's $100, but he told me the other day that he thinks it's going to $150 by Christmas. So he said, you just cannot own enough of this, right? So what can I tell you? He's very bullish on the satellite business, and I guess it's all because SpaceX goes public this year, this summer, and Musk starts talking about what his Starlink is worth, and he gets to $1 trillion. Well, Telsat, in fact, has some superior technology apparently in their network, and it's got a market cap of like $5 billion. So you might get some excitement coming Telsat's way, right? And so anyway, that's all interesting. We've been doing that for a while, but he said if you really want the no-brainer trade for Canada, you go long Quebecor. And this is not a new idea, right? But he says it's working very, very well, and it's just going to continue to work. So you go long Quebecor, and you short TELUS. He thinks TELUS. He said TELUS is not a great investment right now. They've got $50 billion in debt. He thinks the dividend is going to be cut. They have no choice. Of course, the yield's 10% right now, so I'm sure the market's expecting a cut too. But okay, and the principle is, and what he's heard is that our lovely government, the feds, have gone to Quebecor and told them that we'll give you whatever you want. You need permits, you need licensing, you need strategic stuff, whatever you need, you just tell us for your freedom offering, right? The cellular phone business, because we need to bring down cell phone rates in Canada. And so it's kind of a hidden policy of the government. We pay these extraordinarily high rates, as you all know. You're all paying them, and the government wants them down. But of course, they're not going to do anything overtly. They're going to do it subversively. And what they're going to do is back Quebecor. And so there's a trade for you, right? You go long one company that's doing very well. By the way, it trades at a lower multiple and has a much stronger balance sheet. These guys have the strongest balance sheet of all the telcos by far, right? And so I think there's a lot of merit to that thing. So it's kind of like TELUS is good. Well, Quebecor is going to grow their wireless business from 7% of the market to 15, and maybe high teens, but it's definitely going to go to 15%. It's like unstoppable, right? Just natural churn will take them there. But anyway, cheaper pricing will get them there, and so that's material for those guys. So the company will be 30% bigger, and TELUS is going to be going to suffer on the other side. They're all going to suffer on the other side, and but these guys have so much debt that I'm not sure how they sleep at night. So how's that for a riskless trade? And it should work. So we're doing that. We've strapped that on. And silver, I'd just like to point out that both copper and silver now together trading in tandem, both breaking out. And I don't think anybody really knows how high these things could go. And so I think you need to be long this space, as I'm sure you all are, but I think it's just all being confirmed for us in the market. So buy more, and that's basically it for me.
Okay, good stuff. Thanks. Gilbert, you want to wrap things up?
Just get my screen here. Hope everyone can see. So this is a short report. It's going to be a quick one as well. S&P 500 continues to move higher here above its long-term support. This is something that I think David Rosenberg talked about on Monday, which is the CAPE ratio. He called it, I think, his favorite valuation metric. Again, we've been tracking this for some time, and it's now essentially basically where it was at the dot-com peak. And even if we were to get a repeat here, you notice that it spent over a year at this level, right? So it wasn't necessarily something that just kind of was a flash in the pan, hit it, and then turned around. This took some time for it to develop. Now, what's really interesting, this is from Carson Investment Research. I found this, not a chart, but it's a table here, and it shows that when you have 6 weeks of the S&P 500 being positive and a win streak above 10%, what you essentially have is more upside. So going all the way back to the 1950s, this has happened 6 times. Sorry, excuse me, this has happened 9 times with a current one included. And when you take a look, what really matters about this table is the bottom right there, which is 52 weeks post the rally. the market is up an average of 17%. And when you look at the last 5 times this has happened, or the last 4 times this has happened, the market's up an average of 30%. That would take the S&P 500 up to 10,000 by next year. So that's quite a lot when you think about it. But this is just what history tells us. Again, market breadth. I think Joe talked about this. Even though the market seems to be moving higher and higher and higher, we have market breadth that is not as strong, and so participation is still possible. Increased participation is still possible on the near term and also the longer term market breadth charts. Defense versus growth, again, looking all the way back to 2000. That's the last chart here. Yeah, we're still not at that level that we saw at 2000. And even if we were to get there, it wouldn't necessarily mean that that's where it's going to stop, given the relative gradual move of this rotation into growth starting, I guess, in 2016, and then moving higher. So if you are concerned about the market, and I think one of the best ways to look at this is if you want to stay invested, given the fact that there might be a blow off top, or you're concerned about sharp downside reversals in the interim, we have a solution with our partners at Universa. So if you're watching this on YouTube or anywhere else, give us a call and we will find a way to provide that solution to you. So that's it. That's it for me this week.
Great. Thanks, Gilbert. Anybody have anything else before we wrap this up?
Nope.
Okay. Have a good one, everyone. Bye for now.
Thanks for listening to Lighthouse Outlook. If this conversation sparked a new perspective, share it with someone who thinks differently. Subscribe for fresh episodes every 2 weeks and visit mcnichollasset.com to learn more.